Today, we're diving deep into one of the most talked about earnings reports this season, BSE Limited. They just dropped some absolutely mind-blowing numbers. But what's the real story behind this massive profit surge? Let's get into it. So let's just start with the headline number, the one that's got everyone talking. 174%. I mean, wow. That's the year-over-year jump in net profit for BSE's third quarter. And, this isn't just good growth. This is explosive. It's the kind of number that tells you something fundamental, something huge has changed inside this company in just the last year. And here's what that 174% actually looks like. Last year, BSE brought in a solid 220 crore rupees in profit. Respectable, right? Well, this year, they didn't just beat that, they absolutely smashed it, hitting 602 crore. This isn't just a little step up, it's a giant leap that completely changes the company's earning power. But here's the thing. It wasn't just about making more money. The company itself became way more profitable. Just look at their operating margin. It nearly doubled, going from 31% all the way up to 59%. To put it simply, for every 100 rupees they made, they went from keeping 31 as profit to keeping 59. That is an incredible jump in efficiency. So you have to ask the question, right? A profit surge like this and margins expanding that much, that stuff doesn't just happen on its own. There has to be a powerful engine somewhere inside the business that just suddenly kicked into overdrive. So what was it? And here you have it. The answer is equity derivatives. We're talking about financial instruments like options on big indexes like the Sensex and BankX. This one segment became the absolute powerhouse for BSE this quarter. It wasn't just part of the story, it pretty much was the entire story. And the numbers, well, they speak for themselves. The company's total revenue was over 1,200 crore rupees. Out of that, a massive 784 crore came from derivatives. Just derivatives. That's more than half the company's entire income from a single segment. It just goes to show you how successful their strategic focus has been. Okay, so the numbers are phenomenal. No doubt about it. But as anyone who follows the market knows, one great quarter can sometimes be a fluke, right? So we have to ask, are the company's fundamentals, its foundations, actually strong? Is this growth something that can last? To figure that out, we can use a really solid, time-tested framework. We're going to use a system called CanSlim. Think of it like a 7-point health check for a growth stock. It was designed specifically to spot companies that are not just growing fast, but also have solid foundations. So let's put BSE to the test and see how it scores. All right, let's run through this report card. First up, C for current earnings. With 174% growth, that's a huge pass. A for annual earnings, also a pass. They've shown consistent growth over time. N for new product or highs? Well, with the wild success of Sensex options and the stock hitting new highs, that's a definite checkmark. S for supply and demand? Pass. The heavy trading volume shows a ton of interest. L for leader? For sure, it's leading its industry. I for institutional sponsorship? Yep, the big funds are buying in. But then we get to M for market direction. And here, we're going to put a watch. See, the stock's in an uptrend, but there are some outside forces creating a bit of uncertainty. And that little watch on market direction is actually pretty important. Because let's be real, no company exists in a bubble. To get the whole story, we need to zoom out and look at the competition and some of the challenges coming up on the horizon. Yeah, despite this absolutely stellar performance, the market has thrown a couple of curveballs at BSE recently, some headwinds that could definitely make the journey ahead a little choppy. Here is a perfect example. Not long ago, the government announced a hike in the Securities Transaction Tax, or STT. Now, this is a tiny tax on every trade, but the hike was specifically aimed at futures and options, the exact segment that's driving all of BSE's growth. And the market's first reaction? Pure fear. The stock took a nosedive, dropping a sharp 15% in a single day. But this is where the plot thickens. That initial panic didn't last. The stock didn't just stop falling. It bounced back, and it bounced back strong. Why? Because the market quickly shifted its focus away from the bad news and back to the incredible earnings. The results were just too good to ignore. And then you've got the competition. BSE's main rival is, of course, the National Stock Exchange, the NSE. And while the NSE is still the big dog in overall trading volume, you can see the real battleground right here. BSE is making these really smart, targeted moves, and it's grabbing significant market share in the super profitable options segment. It's chipping away at its rival's fortress where it hurts the most. So let's pull all this together. We've seen the incredible numbers, we've checked the fundamentals, and we've looked at the market challenges. What's the big picture here? What's the key takeaway from all this? So let's quickly recap the story so far. It kicked off with absolutely blockbuster results, that 174% profit jump. We found out that was fueled by one powerhouse engine, equity derivatives. Then we ran a health check with the CanSlim framework and saw that the fundamentals look really strong. And finally, we put it all into context by looking at the big challenge, fighting a powerful rival while dealing with market risks. Which leaves us with this one final critical question. BSE's amazing quarter proves it's winning a really
Okay, let's unpack this. Imagine for a second you own a business.
Right.
And not just, a lemonade stand, but a serious publicly traded company. You've been busting your back all quarter, cutting costs, making deals.
The ideal scenario for any CEO, really.
Exactly. And then Judgment Day comes. You get the report card for the quarter Q3 of fiscal year 2026, and it is just glowing. I mean, absolute valedictorian status. We're talking a profit jump of 174%.
That is a massive number. In the corporate world, doubling your profit is, rare enough. But getting close to tripling it, that's when the champagne corks usually pop.
Right. 174% growth in net profit, record revenue. Fundamentally, everything is pointing up. So logically, if you're holding shares in this company, you're thinking, I'm about to be rich.
That is the intuitive expectation.
You expect the stock price to just shoot to the moon.
Better business equals better stock price. It's linear logic.
But here is where it gets really interesting, and honestly, kind of maddening if you're new to this game. We're looking at a specific case study today that takes that logic, crumbles it up, and just throws it in the trash.
Ah, yes.
We're looking at the BSE, the Bombay Stock Exchange, and specifically what happened on Friday, February 13th, 2026.
Friday the 13th. A fitting date for a horror story, really.
Seriously. Because despite those stellar, record-breaking numbers, the stock didn't go to the moon. It tripped at the starting line and face-planted.
Yeah.
If you bought the headline, you lost money.
It's a classic, albeit painful example of a market paradox. And that is really our mission for this deep dive.
Yeah.
We aren't just reporting the financial news here. We have a stack of sources, the headline financial results for Q3, and crucially, a technical candlestick chart from the NSE that captures the price action on that specific Friday.
We're going to play detective today, because if you just read the headlines, you'd think everyone got rich. But if you look at the chart, well, it tells a very different, much darker story.
It really does.
So let's start with the good news. Just how good was this report? Because I want to make sure I'm not misreading 174%.
No, you aren't misreading it. It was objectively excellent. The headline numbers for Q3 showed net profit surged 174% year-on-year.
Wow.
Revenue was also at a record high. Fundamentally, the business was performing better than it ever had. There were no hidden gotchas in the spreadsheet.
See, that's what gets me. If I'm a learner, someone just getting into investing, and I see a 174% jump, my brain screams BUY.
Of course.
I'm thinking, this is it. This is the rocket ship. Why wouldn't I die that?
And that is a very natural reaction. But it relies on that linear logic we mentioned. Good news equals stock goes up. Bad news equals stock goes down.
But the market isn't like that.
It's rarely linear, and it is almost never backward-looking.
Backward-looking? What do you mean?
Think about it. An earnings report tells you what happened in October, November, and December. It's history. The stock market doesn't care about what you did. It cares about what you are going to do.
And what everyone thought you were going to do.
And more importantly, what everyone thought you were going to do. Precisely. It's a game of expectations versus reality.
And in this case, reality, even a great reality, ran into a brick wall of expectations.
Exactly.
So let's look at the car crash itself. I'm looking at this chart right now. And for everyone listening, just visualizing this, it's not a happy green line going up. It's a distinct jagged shape.
Right. Let's focus on the visual evidence. We are looking at a daily candlestick chart. Now, for anyone who hasn't stared at these for hours, a candlestick tells you 4 things about the day: the open, the high, the low, and the close.
Okay, so walk us through the numbers. The bell rings on Friday morning. The news is out. Profits up 174%. What happens next?
So the market opens. The excitement is palpable. The stock opens at 300.0000 exactly. Now, keep in mind, this is a gap up. It opened much higher than it closed the day before.
So the learners are rushing in. FOMO is kicking in hard. Get me in, get me in.
Exactly. Fear of missing out is in full effect. Buyers rush in, fueled by that headline, and they push the price up to a high of 327.0.
So pause there. If you bought at the very start, at 3,100, and you see it hit 327 5 minutes later, you're feeling pretty smart.
You're feeling like a genius.
You're probably already texting your friends about your big gains.
For a few minutes, yes. But that 327 mark, that was the peak. That was the absolute ceiling. From that moment on, the mood shifted drastically.
What happened? I mean, did some other news come out?
No, nothing fundamentally changed. But the supply suddenly overwhelmed the demand. The sellers stepped in. And they didn't just sell a little, they unloaded.
Whoa.
They pushed the price all the way down to a low of 31.27 down to below 30.20. That's a drop of over 100 points from the high.
Correct. And it eventually closed the day at 325.32. So let me get this straight. The company announces it almost tripled its profits. The stock opens at 3,100. And by the time everyone goes home for the weekend, the stock is worth 30.25. It actually lost value on the day the best news in its history came out.
That is the cold, hard reality. And visually on the chart, this creates a big red candle.
Right.
The body of the candle is red because the close was lower than the open. But what's really fascinating, and this is the key to reading the crime scene, is the wick.
The wick. You mean that little line sticking out the top?
Yes. That upper wick represents the distance between the open price and that high of 31.27. Think about what that line physically represents. It represents the path the buyers traveled. They marched up the hill to 31.27.
They planted their flag.
And then they got absolutely slaughtered and pushed all the way back down.
It's a memorial to failed optimism.
Exactly. That wick is visual proof of rejection. It shows us that buyers tried to push it higher. They tried to break out, but they were completely overwhelmed. It's like a runner sprinting out of the blocks, right?
Yeah, hearing the crowd cheer.
Exactly. Thinking they've won the gold medal, and then they just collapse 50 meters before the finish line.
That is brutal. But this brings us to the million-dollar question. Why? Why does the market punish success? I mean, is the market just broken?
It's not broken, and it's not a scam, but it is operating on a mechanism that most beginners don't see. To understand it, we have to look away from February 13th.
You need to zoom out.
We need to look at what happened before it. Look at the left side of the chart.
Okay, I'm looking at the chart here. Leading up to February. Wow. That is a steep hill.
It's a very aggressive uptrend. I mean, if you look at late January and early February, you see just a stack of green candles.
Yeah.
The price moved from the 2,500 level up to the 3,000 level in a very short amount of time.
It was on a tear.
It was. And this brings us to the core financial concept of this deep dive. You've heard it before, I'm sure.
Buy the rumor, sell the news.
Exactly. Buy the rumor, sell the news.
I have heard it. It sounds like something from a spy novel. But break it down. What does it actually mean mechanically?
Well, the market is a discounting mechanism. It is constantly trying to predict the future. The smart money, we're talking institutional investors, algorithms, the pros, they don't wait for the press release.
Right.
They analyze shipping data, they talk to suppliers, they run complex models. They likely anticipated that BSE was going to have a blowout quarter weeks ago.
So they were placing their bets before the race even started.
Exactly. They started buying at 2,500. They bought at 2,600. That buying pressure is what drove the stock up to 3,000 before the news ever dropped.
So that climb from 2,500 to 3,000, that wasn't random. That was the market guessing the answer to the quiz.
Correct. The price rose in anticipation. The 174% profit jump. That was essentially already priced into the stock when it hit 3,100. The market had already paid for that news.
So when the news actually hit, nobody was surprised.
Well, the learners were surprised, the retail investors were excited, but the pros, they looked at the headline and said, okay, our prediction was correct, and then...
Time to sell.
Now, here's the important part. Let's take our profits off the table.
But wait, if the news is good, why sell? Why not just hold forever?
Because big institutions move massive amounts of money. If a hedge fund wants to sell 1 million shares to lock in their profit from the last month, they can't just click sell on a quiet Tuesday.
There wouldn't be enough buyers.
Exactly. They need liquidity. They need a flood of eager buyers. And when is the best time to find a flood of eager, excited buyers?
Oh no. The morning the good news comes out.
The morning of the earnings report. The learners see the headline and rush in to buy at 3,100. The pros use that surge of demand to offload their shares. They are selling into the strength.
Yeah, it is ruthless. It's basically a trap. The amateurs are providing the exit door for the professionals.
It can certainly feel like a trap, but it's simply how liquidity works. The wealth transfers from the impatient who buy the headline to the patient who bought the rumor.
Okay, so I'm feeling a little paranoid now. It feels like I'm sitting at a poker table and I'm the patsy.
Yeah.
How was I supposed to know? Were there signs?
The signs were there. They were flashing neon red lights. But you have to know how to read the language of the chart.
Okay, Jesus. Let's decode those warning signs.
Yeah.
You mentioned something called Bollinger Bands in the source stack. Now that sounds like a 70s rock band.
It does sound musical, doesn't it? Live at the Apollo, the Bollinger Bands. But no, it's a volatility indicator. Look at the chart again. Do you see those green wavy lines that are enveloping the price candles?
Yeah, it looks like a tunnel or a road that the stock is driving on.
Think of them as the guardrails of the road. These bands are calculated using standard deviation. Basically, they measure how wide the road is, and the price usually stays inside the bands.
Okay, so what happened leading up to Friday the 13th?
Look closely at the candles just before the drop.
The candles are pushing right up against that top green line. In fact, some of them are poking right through it.
Exactly. When the price consistently touches or pierces the upper Bollinger Band, it's a statistical signal that the stock is overextended. It's like a rubber band that has been stretched to its absolute limit.
And when you stretch a rubber band too far,
It snaps back. It has to. It's called reversion to the mean. The price had moved too far, too fast, away from its average. So that's warning sign number 1.
okay, noted. Don't buy when the rubber band is about to snap. What's warning sign number 2? I see another graph at the bottom panel labeled RSI.
Right. RSI stands for Relative Strength Index. Think of this as the speedometer for the stock's engine. It measures momentum on a scale from 0 to 100.
Okay, so 0 is stopped, 100 is max speed.
Roughly, yes. And in technical analysis, the danger zone is usually above 70. If the RSI is above 70, the stock is considered overbought.
Overbought. That sounds exactly like what it is. Too many people bought it too quickly.
Yes. It means the engine is redlining. You know what happens if you drive your car with the RPM needle in the red for too long?
The engine blows up.
Exactly. Now, where was the RSI for BSE leading up to the earnings?
I'm looking at the line.
Yeah.
It's high. It's hovering around or just above the 75 mark.
So you have a speedometer redlining at 75. You have the car crashing into the guardrails, the Bollinger Bands, and then the earnings report hits. That's like slamming on the gas pedal when the engine is already smoking.
It just couldn't take anymore.
It was exhausted. That's the word traders use. Buyer exhaustion. The stock ran a marathon from 2,500 to 3,100. It didn't have the energy to sprint another lap, no matter how much the crowd cheered.
And that's why the 174% profit number didn't matter in that moment. The fundamental news said go, but the technical reality, the engine and the tires, said stop.
And in the short term, technicals almost always win.
This connects back to something else on the chart, the volume. I see some bars at the very bottom. On the day of the drop, that volume bar looks pretty tall.
That is the final confirmation. Volume is the truth serum of the market.
Why? Can't it just be a few panic retail traders selling?
If the price dropped on low volume, you might say, oh, just a few people panic sold, no big deal. But when you see a price drop on high volume, that indicates conviction. That means the big whales, the institutions, were exiting. It wasn't an accident. It was a mass evacuation.
So putting it all together, the learner buys the headline at 3,100. The pro sees the redlining engine, the stretch rubber band, and decides to sell to the learner.
That is the dynamic.
It feels so unfair when you say it like that.
It's not about fairness. It's about preparation. The learner looked at one data point, the news. The pro looked at 3, the trend, the technicals, and the liquidity.
So what does this all mean for our listener? If they are sitting there with their finger hovering over the buy button next time a big earnings report comes out, what's the checklist?
They need to be ambidextrous. They need to look at the spreadsheet. Yes, earnings matter for the long term, but before they click buy, they must look at the chart.
Step 1.
Check the speedometer. Is the RSI above 70? If yes, wait.
Step 2.
Check the guardrails. Is the price piercing the upper Bollinger Band? Has it already run up 20% in the last 2 weeks? If yes, wait.
And step 3.
Let the event happen. Let the sell-on news occur. If the company is truly great, and BSE's numbers are great, the stock will eventually go up. But it might need to drop to 2,900 or 2,800 first to cool off the engine.
So you're not saying don't buy it. You're saying don't buy the top.
Exactly. Buy the business when it's on sale, not when it's priced for perfection and overheating. Patience pays.
That's great advice. It's about not being the person catching the falling knife, or in this case, the person holding the bag for the pros.
Precisely.
Okay, let's recap before we close out this deep dive, because we covered some heavy concepts.
Sure. The main lesson from the BSE case study on February 13th, 2026, is that a record-breaking earnings report, even 174%, does not guarantee a stock rise.
In fact, if everyone already expects it, it can trigger a sell-off.
Right. We learned that the market is forward-looking. The rally happens before the news. If you're waiting for the headline to buy, you are very often too late.
We also talked about the visual proof. That red candle with the long upper wick, the shadow of rejection.
Which showed us that buyers tried to take control but failed. And finally, we learned about the warning signs. The Bollinger Band showing the price was overextended, and the RSI showing the momentum was overbought.
It's a textbook example of why you have to look at both the fundamentals and the technicals. You can't drive a car just by looking at the speedometer. You have to look at the road, too.
Couldn't have said it better myself.
Yeah, before we go, I want to leave everyone with a thought. A slightly terrifying thought, actually.
Oh.
We've been talking about a company that did everything right. They knocked it out of the park. 174% profit. And they still got sold off because the market expected it.
It raises a frightening question about expectations, doesn't it?
It really does. If 174% profit jump results in a sell-off because it was priced in, imagine what happens if a company is priced for perfection and they deliver merely good news or, heaven forbid, just okay news.
That is the scenario that keeps portfolio managers awake at night. If perfection gets punished, mediocrity gets slaughtered.
Mediocrity gets slaughtered. Put that on a t-shirt.
If the expectation is triple your profit and you only double your profit, the market treats it like a failure. The drop wouldn't be 3 or 4% like we saw here.
No.
You'd be looking at a gap down to 15 or 20%.
That is the risk. So keep your eyes on the chart, watch out for those rubber bands, and don't let the headlines fool you. Thanks for diving in with us.
Always a pleasure.
We'll catch you on the next deep dive.